Welcome to our finance channel. In this video, we will explore the top quotes from Ray Dalio, one of the most successful and respected investors of our time. We will analyze these quotes in the context of expert-backed research in finance to understand their relevance and applicability in the world of investments. Without further ado, let's get started. 1. Diversification is key to minimizing risk in an investment portfolio. This quote from Ray Dalio emphasizes the importance of diversification as a fundamental strategy for reducing risk in an investment portfolio. Numerous research studies support this statement and demonstrate that diversification can be a crucial element in risk management and long-term return maximization. The pioneering work of Harry Markowitz on modern portfolio theory, published in 1952, provides a solid foundation for understanding the importance of diversification. Markowitz introduced the concept of diversification in asset selection, arguing that by combining different asset classes with low or negative correlations, investors can reduce the overall risk of the portfolio without sacrificing potential returns. A practical example of diversification is the combination of stocks, bonds, and alternative assets such as commodities or real estate within a portfolio. Geographic diversification, by investing in different regions or countries, can also provide greater protection against specific risks in the local market. 2. Patience is a virtue in long-term investing. Ray Dalio emphasizes the importance of patience as a crucial virtue in long-term investing. This statement is supported by research that has shown that successful long-term investors are those who maintain a long-term perspective and avoid reacting impulsively to short-term market fluctuations. A relevant study is the work of Eugene Fama and Kenneth French on the persistence of returns, published in 1992. This study examined the performance of stocks in the stock market over the long term and found evidence that stocks with high past returns tend to have superior future performance, while stocks with low past returns tend to have inferior future performance. This supports the idea that maintaining a long-term investment can allow investors to capture the long-term positive returns of stocks, even amidst short-term market fluctuations. By being patient and not getting caught up in market noise or momentary emotions, investors can benefit from the overall trends and long-term appreciation of the assets they invest in. 3. Understanding and managing risk is as important as seeking investment opportunities. Ray Dalio highlights in this statement the importance of understanding and managing risk in the investment process. This assertion is based on research that supports the idea that risk management is crucial for achieving successful investment outcomes. One of the key works in this area is the study by Daniel Kahneman and Amos Tversky on prospect theory, published in 1979. This study reveals that investors have asymmetric risk aversions, meaning they tend to value losses more than gains in a similar situation. This implies that investors have a greater concern for avoiding losses than for achieving gains. Another relevant research is the work of Brad Barber and Terence Odeon on investor behavior, published in 2000. This study demonstrates that many investors tend to make impulsive and emotional decisions, which can lead to suboptimal outcomes. Understanding and managing risk help counter these tendencies and make more informed and rational investment decisions. 4. The best investor is the one who can admit their mistakes and learn from them. In this statement, Ray Dalio highlights the importance of being able to recognize and learn from mistakes made in the investment process. This idea is supported by Odeon's study on the influence of overconfidence on investment decisions, published in 1998. Odeon's study examined how overconfidence can affect people's investment decisions. It found that investors tend to overestimate their ability to select stocks and outperform the market. This leads to higher trading frequency and a decrease in the performance of their portfolios. Overconfidence can cause investors to ignore warning signals or relevant information and cling to their initial decisions, even when evidence suggests they are wrong. This lack of adaptability and refusal to admit mistakes can result in significant financial losses. Ray Dalio's statement emphasizes the importance of being aware of our limitations and being able to recognize and learn from mistakes made. A successful investor not only seeks to maximize profits but is also willing to acknowledge when they are wrong and adjust their strategy accordingly. 5. Successful investment requires a systematic and principle-based approach. In this statement, Ray Dalio emphasizes the importance of having a systematic and principle-based approach to achieve successful investments. This idea is supported by Burton Malkiel's book A Random Walk Down Wall Street, published in 1973. Burton Malkiel's book examines the efficiency of financial markets and argues that asset prices reflect all available information at a given time. Based on this premise, Malkiel advocates for a systematic and principle-based approach, such as passive investment through indexed funds, rather than trying to predict market behavior. A systematic approach involves following an established strategy based on clear rules, rather than making decisions based on emotions or subjective predictions. A systematic investor adheres to a set of principles and consistent processes in their decision-making, which helps eliminate the influence of emotional biases and reduces the likelihood of costly mistakes. By following a principle-based approach, investors are guided by solid and fundamental principles rather than being swayed by temporary fads or trends. These principles may include diversification, fundamental analysis, risk-reward evaluation, and attention to underlying economic and financial fundamentals. Research supports the importance of a systematic and principle-based approach in investment. Malkiel's book presents the notion that markets are efficient and that asset prices already reflect all relevant information. Therefore, consistently and accurately predicting market movements is largely seen as an ineffective approach. Instead, adopting a systematic and principle-based approach, such as passive investment through indexed funds, has been shown to offer solid and consistent results over time. By following sound principles and avoiding speculation or constantly trying to outperform the market, investors can reduce risks and increase the likelihood of achieving long-term returns. 6. Time in the market is more important than trying to time the market. In this statement, Ray Dalio highlights the importance of staying invested in the market for extended periods rather than attempting to time market movements. This idea is supported by Bogle's study on the effects of long-term investing on returns, published in 2014. Bogle's study examined the returns of different long-term investments and compared the results of investors who tried to time the market with those who adopted a long-term investment approach. The results showed that, overall, investors who held their investments for extended periods achieved better returns compared to those who attempted to make buying and selling decisions based on short-term market fluctuations. Time in the market refers to the total duration of the investment, where investors stay invested through market ups and downs and benefit from the power of long-term growth. Trying to time the market involves trying to predict the optimal times to buy and sell assets in order to make quick profits or avoid losses. However, evidence has shown that consistently and accurately timing the market is extremely difficult, and even experts struggle to do so consistently. The study supports the idea that staying invested in the long term tends to generate better results. The financial market has shown a long-term upward trend throughout history, despite short-term fluctuations and occasional crises. By staying invested for extended periods, investors can take advantage of long-term growth and compounded returns, which can lead to more favorable outcomes. 7. Understanding economic and political trends is fundamental for investment decision-making. In this statement, Ray Dalio emphasizes the importance of understanding economic and political trends when making investment decisions. This idea is supported by Blanchard and Watson's study on the influence of macroeconomic variables on market returns, published in 1986. Blanchard and Watson's study examined the relationship between macroeconomic variables such as economic growth, inflation, interest rates, government policies, and financial market returns. The results showed that these macroeconomic variables can have a significant impact on market returns and investment decision-making. Understanding economic and political trends is essential for investors, as these trends can influence asset prices, credit availability, risk levels, and growth expectations. For example, a growing economy with favorable fiscal and monetary policies tends to create favorable conditions for investors, while a recessionary economy or restrictive policies may present challenges. By understanding economic and political trends, investors can make informed decisions regarding asset allocation, investment selection, and risk management. For instance, if strong economic growth is expected, investors may consider increasing their exposure to sectors and regions that benefit from this trend. Similarly, if changes in government policies are anticipated, investors can adjust their portfolio accordingly to mitigate risks or seize opportunities. In summary, these were the 10 impactful quotes backed by science from Ray Dalio in the field of finance. If you enjoyed the content, don't forget to like and subscribe for more videos related to financial success. This video does not provide professional financial advice. Always consult with an expert before making significant financial decisions. In summary, these were the 10 impactful quotes backed by science from Ray Dalio in the field of finance. If you enjoyed the content, don't forget to like and subscribe for more videos related to financial success. This video does not provide professional financial advice. Always consult with an expert before making significant financial decisions.